I can't get desktop to display in the left-hand view. Yep, I've got it on the right, but I can't get it on the left. Okay. Display. Yep. Okay, thanks. Okay, can you hear me up the back? No. Can't hear me? Yeah? Yep, can? Excellent. Okay, so someone's coming along to help us with this desktop, but we'll get started anyway, as long as you can hear me. Yes, great. Okay, so this is your second lecture, and remembering that your online quiz, which takes place in your lecture time in week 6, is on the first 4 topics. So this is an important, they're all important topics, but certainly if you can keep up to date in these first 4 weeks, it will set you up very well for your online quiz. And I'm sure you're all enrolled in a lecture time, but there are 24 people who are not, and they won't be able to access the quiz unless they enrol in a lecture time. So if you know someone who hasn't enrolled in a lecture time, please let them know. And SciNet closes on Friday. So after that, we'll just be allocating the remaining unallocated students to a lecture time. Okay, so today it's your second topic, as I said. Last week we talked about kind of introductory management accounting concepts and what management accountants do. And hopefully you've been to a tutorial this week and gone through that material again. And that you can all now do a schedule of cost of goods manufactured and sold, because you'll definitely have to be able to do that. Today we're talking about cost behaviours and CVP analysis. Some of you may already be familiar with this, which is fantastic, but we're also going to learn some other tools and techniques like operating leverage. So today, these are the objectives. We want you to know and be able to interpret how costs behave and why we need to know how costs behave. We want you to be able to define a cost function and describe 3 different types of linear cost functions. We want you to determine how costs behave. We want you to be able to do a cost estimation, and we're going to talk about different methods of doing that. Scattergram method, the high-low method, which is the method you will have to do on your online quiz, and the regression method. We want you to be able to evaluate cost drivers. So these are variables that cause costs to change. And we want you to understand the different ways of evaluating those cost drivers. So economic plausibility is the most important. There should be a cause and effect relationship between the cost driver and the way the cost behaves. But we'll also talk about goodness of fit and the slope of regression. The fifth objective is that you can all perform a cost volume profit analysis, and not only for a single product, but for batches of products. So calculating break-even point and calculating how many units you need to produce and sell in order to make a particular profit. As always, there's multiple methods of doing this, and we'll teach you about those different methods. The final thing is about operating leverage, and I'm sure some of you have come across this term leverage in your finance studies, if not your other accounting studies. But it has a particular meaning here, and we're going to learn about that today. So is everyone okay? Any questions so far? Okay, so cost behaviour. So last week we really just talked about categorising costs as direct or indirect, manufacturing or non-manufacturing inventoriable or period costs. Are all those words sounding a little bit familiar? I hope so. So what we're talking about today is how costs behave. And so cost behaviour is how a cost will react to a change in the volume or the level of activity. Thank you. So a cost driver is a variable that such as the level of activity or the volume of product that we produce, that causally affects how costs change over a given period of time. And as management accountants, you would need to be able to identify cost drivers when we're talking about variable costs. Do you need me to stop? Oh. Okay. So will it record from that? Okay. Okay, thanks. So we've got a problem with the bulb on this side. I do apologise. So we only have this one screen for today. Okay, so knowing how a cost behaves is useful for managers for planning and control decisions. Remember last week we talked about how managers need to be able to cost their product in order to price their product to hopefully make a profit. But we also talked about how it's useful to know what our costs are for planning, so our future profits, to make decisions about what we're going to do to ensure that we meet our organisational goals, and control, where we compare what we actually achieved with what we planned to achieve so that we got feedback about our performance. Okay, so we can categorise costs as behaving in a variable way or a fixed way or as a mixed cost. So a variable cost in total changes in proportion to the change in activity. So we have activity on the x-axis and costs on the y-axis, and we start at 0 and we increase with every unit of activity in an equal fashion. So we've got a straight line. So this is just an example. You can have non-linear costs, but we're going to focus on linear costs today. So variable costs in total, and that's very important, increase with the units of activity, whereas a fixed cost remains unchanged. It's constant in total for a relevant range of activity. So in this graph, the range is from 0 to 200. The cost, the total fixed cost, remains constant. Okay, so what's really important here is that it's in total for a given time period, and there's wide changes in the related level of total activity or volume. So what we refer to this time period, where there's this range of activity, that's called the relevant range. Okay, so this cost is fixed over the relevant range of 0 to 200. It might be that when we produce 201 units, the fixed cost jumps up because we have to perhaps lease another factory, because the factory we have, we can only produce 200 units in. So that's what we call a stepped fixed cost. So an example of a variable cost might be, we talked about computers or monitors last week, and it might be that with every new monitor you make, you obviously have to provide a screen. So as you create more monitors, you have more costs of buying screens to put in those monitors. So in total, your costs increase with each monitor you make. Whereas a fixed cost might be, as I said, the lease on the factory. So if we create 200 computers, we only need one factory. So the lease costs might be that it costs you $15,000 to lease the factory. That's fixed. Whether you create one computer or 200 computers, that's a fixed cost in total. All good? Okay, so we can describe costs as a linear equation. So in this case, y is our total costs, a is our fixed portion, bx is our variable portion. So this bx represents the slope of this line. B is the slope, x is the units of activity. So x might be the volume. So B stands for the variable cost per unit. A is the total fixed cost. We all good with that? So if we just have a variable cost, y equals bx, there's no A. There's no fixed cost. If we just have a fixed cost, your total cost will equal A. If we have a mixed cost, which means you have a portion that is fixed and a portion that is variable. So this diagram is of a mixed cost. You know that there's a fixed portion because it crosses the y-axis at 4,000. So that represents the fixed portion of our mixed cost. So your A would be 4,000. Is everyone with me? It's pretty simple. Okay. So B, the variable cost per unit, is the slope of this line. Okay, so we demonstrate that here, and we calculate B by calculating the change in the cost over the change in the activity. So the value of A here is 0. What's that telling us? What kind of cost is this? Is it variable, fixed, or mixed? It's variable, completely variable. There's no fixed component of this cost because this graph crosses the axis at 0, meaning that if I have no portion of this cost that is fixed, it's just every unit I produce, the total cost increases by the same amount. This fixed cost, obviously, what is the fixed cost equal to here? How much is the fixed cost? 10,000. Okay, it doesn't change over this relevant range of activity. What's the value of B? 0. Okay, great. So this is very important that it's in total. So how do we... The criteria for classifying a cost as fixed or variable, and we know now that a particular cost might be both variable and fixed. So it really depends on what your cost object is. So remember last week we talked about you have to know what your cost object is if you want to cost it. So what is it that we want to determine the cost of? So if we think about, if we just own a taxi, if the taxi is our cost object, the annual registration and licence fee for that taxi is a fixed cost. We pay an amount for the entire year. Doesn't matter how far we drive the taxi, we pay a certain amount for registration, say $700, it's a lot more than that, but yes, say $700, and we pay a certain amount for our licence fee, and that is fixed. So if we don't drive that taxi at all, we still have to pay that cost. If, however, your cost object is a fleet of taxis, that licence and registration fee becomes a variable cost because it will increase with the number of taxis that you purchase, you put into your fleet. So you have to be very careful when you're deciding whether a cost is fixed or variable, what your cost object is. Remember I told you that for a fixed cost, it will be fixed for a relevant range. So we talked about a cost being fixed between 0 and 200 units that we produce, but also it's important to know that the longer the time horizon, the more likely the cost will become variable. Okay, and this is about costs behave in linear patterns only within their relevant range, and after a period of time, you're more likely to be able to make decisions where that cost behaviour becomes less fixed or is more variable. So knowing the relevant range is really very important to properly classify your costs. Okay, so again, this is a graph of a mixed cost. We've got the fixed component, which is where your costs cross your y-axis, and your variable component, which is the slope of this line. So this is the fixed cost, A. This is the variable cost component, which is made up of the variable cost per unit times the number of units that you produce and sell. Okay, so you can calculate this and this if you know what your total costs are and your activity level for that total cost, and we're going to go on and do that. So an example of a mixed cost might be your mobile phone charge, where you pay a monthly fee and you're charged for extra calls as you make them. So the monthly fee is your fixed part of your mixed cost, and the extra charge for extra calls is the variable part. All good? Great. Okay. So this slide is important because if you're asked a question about cost behaviour, you must be very careful to read it closely, because variable and fixed costs behave in total the way we've just described. In total, variable costs increase with the more units that you produce. In total, fixed costs remain the same in the relevant range of activity. However, per unit, that's not true. Okay? So per unit, because the slope of the line is constant in our example, our variable costs per unit remain the same over the wide range of the activity, because B is constant. B is the variable cost per unit. Our fixed costs, the more activity we do, if we think about fixed cost in total stay the same, but if I produce 1 unit, my fixed cost per unit, say it's $1,000, is $1,000 per unit if I only produce 1. If I produce 200 units, my fixed cost per unit is $5 per unit. Does that make sense? So the more units you produce, the lower your fixed cost per unit within that relevant range. So you'd be very careful if we're talking about in total or per unit. Okay, so this is the diagrammatic form of what I've just told you. So here we have our variable costs. This is how they behave in total. They start off at 0 if you produce nothing, and they increase at the same rate the more you produce. But if we're talking about it per unit, our variable costs per unit are constant. Okay? Does that make sense? So say it's 10 cents a unit, and that's the slope of your total variable costs. Okay, fixed costs in total, here we have it, they don't change in the relevant range, but the more units we produce, the fixed costs per unit decrease, because we're dividing the same number in costs by more activity. Make sense? Okay, so this is in total, this is per unit. Oh. Okay, so I want you to tell me, looking at this data, how you would classify these costs. So this first one, is that fixed, variable, or mixed? It's a fixed cost. It doesn't change in that relevant range, in total. What about this one? Mixed. Okay, how do you know it's mixed and not variable? Sorry? Yeah, so the intersect appears to be 5,000. Yep. What about this one? Variable. It increases by the same amount for each 1,000 units that we produce. Does that make sense? What about this one? Remember this, now this is per unit, hasn't changed, so it's variable. Okay, this would be the slope. This is the variable cost per unit. It's not changing over the number of units that we produce, and so it would be a variable cost. What about this one? Fixed. It's reducing by the same rate the more units we produce. What about this one? What do you think? Fixed, variable, or mixed? Mixed. So it's not reducing by the same rate, so there'll be a portion of fixed and a portion of variable in there. Okay, a mixed cost. Okay, so there are your answers. Does anyone need any of that explained again? Okay. So, what we want you to be able to do is estimate how costs, a linear cost equation. So, is everyone all right? Do you want me to go back a slide? Okay, so you need to be able to identify the factors that actually cause costs to change. An important issue is that you have to be able to understand cause and effect criterion. Is it volume that's making my cost change, or is it some other factor? So what we need to do to identify this cause and effect relationship is it might be a physical relationship between the level of activity and cost. So the more units I produce, the higher my costs. It might be a contractual relationship. For example, I sign a lease document that I will pay $15,000 a year, and that is what is causing my cost to be constant or fixed in total. It might be that we rely on our knowledge of operations to identify what the cost driver is, what causes my costs to change. So really, we're really only looking for cause and effect relationships. We want to identify what is economically plausible association between a particular level of activity and its costs. So what do I mean by economically plausible? Well, it has to be logical and make sense in terms of how much money, what the cost is of that activity. So it might be, it makes sense because we see that the materials that are going into each unit, and therefore we know that with each unit we produce, we use more material, and therefore it causes more costs. Okay, so the techniques that have been used to establish what my cost driver is and what my costs look like, or how they behave, in the past they've used things like industrial engineering method, where there are a whole heap of studies where they did these time and motion studies. They went along and actually timed how long it took people to do certain activities. And they knew that the more time it took them, they related that to the cost of that activity and therefore that product. So you can analyse the relationship between inputs and outputs by actually measuring them. And that's called the industrial engineering method. A conference method is where people within the organisation who understand the processes involved sit around and get information about the costs and talk about it and come to a conclusion amongst each other about how those costs are behaving. We also have an account analysis method where you go back and look at historical costs and activity levels and try to understand how the costs have behaved in the past. And this is what we're doing today, the quantitative analysis method. So it's kind of a formal mathematical model. It's not difficult. It's the model we've already shown you to try and estimate these cost functions based on past observations of activities and costs. So, estimating the cost function, we're going to talk about two quantitative methods. We're going to talk about plotting a scattergram. So you can plot different data points. So plot the total cost against the total activity. And then we can observe on a graph how the cost is behaving. Is it flat? Is it a fixed cost? Is it a mixed cost? Is it a variable cost? So this is a scattergram. You're not going to have to prepare a scattergram, although it's very simple. So all you do is plot the data points on this graph and try and find the line of best fit. Okay, so in this case, what kind of cost would you have thought it would be? Just by looking at the plot. A mixed cost. So, you're going to the line of best fit is going to go somewhere through there. Okay? So it's a very mechanical approach. The approach that you're going to have to be able to do is the high-low method. Now, this is a very simple way of using two data points to estimate the cost function. So what we're trying to do is create this equation to describe the cost. So remember, Y is your total cost, A is your fixed cost, BX is your variable cost total. So we're going to consider only two of those data points. From our scattergram, we're going to consider the data point associated with the lowest level of activity and the highest level of activity. Don't be confused and choose the highest and lowest level of cost. It's the highest and lowest level of activity. They're the two data points you're going to use to estimate your cost function. Remember, it's simple, this method, but there's a drawback. It only uses these two data points, so there's lots of information loss. It's a very average way of working out what your cost function is. It's not terribly accurate, but it's quick. So first of all, we're going to calculate our unit variable cost, so the B in the equation. And then we're going to substitute the B into the equation to calculate A because we know Y. So B is the slope of the line, so that's the difference in costs, the difference in Y, over the difference in X, the activity level. So we're trying to calculate this slope by taking the difference in costs and dividing it by the difference in activity, or the change. Simple? Okay, so an example, they give you the highest and lowest level of activity and they've calculated the change for you. So in this case, when we produce 9,000 units, our data tells us it costs us $9,700. And when we produce 5,000 units, our data tells us that it costs us $6,100. To work out B, the variable cost per unit, we divide the change in cost, the 3,600, by the 4,000, which is the change in the units. So this question is just asking us to work out the variable cost per unit, the fixed cost, then work out what the equation is, and then you can actually estimate how much it should have cost you to produce 6,500 units. Okay, so the unit variable costs, the B, as I said, we divide the 3,600 by the 4,000 units, so we know B is 90 cents per unit. That's the slope of your line. Then we know we have to choose whether we're going to use the high level of activity information or the low level of activity information. Often people get mixed up and choose one of each. Don't do that. So all we're doing is substituting into our equation what we know. We know that our total cost is 9,700. We know our B is 90 cents per unit, and we can just times that by the 9,000 units, and that will give us our total variable costs. So this is total cost, this is total variable cost. If we take total cost and we take away total variable costs, this will give us our fixed cost. This is where our mixed cost, the line, crosses our y-axis. All good? Great. So we can express our linear cost estimation model as y equals 1600 plus 0.9x. And then if we want to know what we think it should cost us to produce 6,500 units, we just use 6,500 as x. All good? But it'll only work within the relevant range. So in this case, we've estimated for between 9,000 units and 5,000 units. So we can't then put in a number below 5,000 and expect to get even somewhere near what it would actually be. Is everyone good? Okay. So a quick check of your understanding. Calculate for me the variable portion of sales, salaries and commissions. We've got 3 data points. So you need to choose the highest and lowest and then calculate B, which is the change in cost over the change in activity. Has anyone got an answer for me? Or a guess? Number 2? Okay, fantastic. How'd you get that? Yep. Yep. Yep, so you took this data point and this data point, and you just took the difference between 14,000 and 10,000 and divided that by the difference between those two. Great. Okay, does everyone understand that? Yes.
How does that match up with the next one?
Well, it doesn't, and that's the problem with using high-low method, because you ignore the data points. And that's the inaccuracy with using this method. So fantastic point. So if you want to be more accurate and you want to use all of the information, you'd use a regression method. So you'd use a statistical math package to get the line of best fit. All good? Yep.
Why would you ever use a high-low method?
If you're sitting in a management meeting and you have data in front of you and you want to quickly make an estimate, but yes, absolutely, with the statistical packages that you have available to you, why would you? But we want to ensure that you understand the underlying conceptual nature of this. Okay. Okay, so the next question, same data. What's the fixed portion of this cost estimation? So what's our A? $10,000? Fantastic. So we know that, sorry, did you say 10 or 2? Okay. Someone else said 2? Excellent. If you, extrapolation, no, you don't extrapolate outside the bounds, it's within. So if we've worked out that y equals a plus bx and b is 0.1, we just use the numbers that we have. We can either use the highest or the lowest and transpose those in. So if we're using the highest, we know the total cost is 14,000. And we know that x for 14,000 is 120,000. So if we solve that, we know that A equals 2,000. Does that make sense? Cool. We all good? So it's not terribly accurate for taking into consideration all of the data points, only the ones that you base your estimation on. Okay, so as you point out, regression analysis would be your preferred method. So you're calculating the line of best fit using all of the data points. It's more objective and rigorous, and you can get an R-squared value that gives you an indication of how well your estimated cost function fits your data. You don't have that with the high-low method, you just know that you're only using 2 data points. Okay, and we all know that only holds for the relevant range within which you've got the data. Okay, so have I lost some people? You all okay? Okay. So when we're choosing a cost driver, what is causing our variable cost to change? We've only talked about the activity or the volume that we produce causing our variable costs in total to increase. So it might be that something else, apart from the volume of units that you produce, it might be machine hours or the materials, the kilograms of materials that have a better cause and effect relationship with our costs. So we evaluate the different potential drivers based on their economic plausibility. We can do a regression analysis with the different drivers as our activity, and we can work out which is the best R-squared, or we can look at the different regression lines and see which one of our activities is actually causing our costs to change over time. So another quick question for you to think about: if I produce plastic bottles in 3 different sizes, using the same machinery, the same people on the production line, using the economic plausibility method, what would be the best cost driver? What causes costs to change? Number 3, the kilograms. Why is that? Yeah, so if they, basically it's because the size of the bottle is different. And we know, well, we're assuming that to produce bottles, it's mostly a machine process, and it takes the same amount of time on the machine to produce each of the bottles, even though they're different in size. There's very little labour involved, but we do know that the change in size means they use different amounts of the materials. So the most economically plausible cost driver would be the kilograms of materials consumed. Does that make sense? Okay. So I'm going to give you a break now, and then we're going to come back and go through cost, volume, profit analysis and operating leverage. So we'll start again in 10 minutes. Okay, so I'm going to restart. So we're going to talk about cost, volume, profit analysis. So you've learned how to estimate in a fairly crude way a linear cost function. And part of the reason we want you to be able to do that is so that you can do cost, volume, profit analyses in a quick way. So what we're interested in knowing, or we're interested in you being able to calculate, is a break-even point. So the break-even point is where you produce enough of your product to make no profit. So you cover all your fixed and variable costs, but you're not making a profit yet. So people are interested in this. Your managers want to know how much do I have to sell before I start to make a profit? And what if I change some of my costs so they become fixed? How will that affect my break-even point? So we want you to, being able to do cost, volume, profit analysis enables you to predict the effects of changes in sales price or the types of costs, or even the total cost, how that will affect your profit, and helps you with planning and observing sensitivity to profit changes. So this graph is just the graph of your total revenue in green. Here's your total costs in red. And we can see that this is the point we're interested in, when your total costs equal your total revenues, and that's when your profit equals zero. That's your break-even point. So above break-even point, the difference between revenues and your total costs will represent your profit, and below break-even point, the difference between your costs and your revenue will represent your loss. So that's what we want you to be able to do is quickly determine that break-even point. Of course, there's a lot of assumptions that we make when we do these types of estimations. We assume that it's possible to divide our costs up into fixed and variable. We've done some very simple examples today, but in the real world, it's actually much more difficult. Costs behave not only in fixed and variable and mixed fashions, but you can have non-linear costs, and you'll be able to determine that using statistical software packages, and so costing and cost volume profit analysis can get much more complicated than what we're doing. But what we're doing is to give you the underpinnings and understanding of how we go about it. We assume that variable costs are proportional to volume or activity. We assume that fixed costs are constant over our output range, our sales price remain unchanged, that our efficiency and productivity remain unchanged. Our volume is the only factor that affects costs, and we all know that that may not be the case. We assume that we produce only a single product, or if we produce multiple products, that we produce them in the same proportion, and that our production equals our sales. So there's lots of assumptions. So you use this as kind of a starting point to understand and predict the effect of some of the changes or some decisions that you make about pricing, volume, types of costs on your profit. So we're going to learn about three methods. We're going to learn about the equation method, which is really longhand, contribution margin method, which is the method I hope that you will take on board and use, and a graphical method. So break-even point occurs when profit equals zero, as I said earlier. So we all know that with the accounting, that our sales less our costs equal our profit. So we're going to use an example here of a kid's toy that sells for $60. So we've got our sales price. We know our total fixed costs are $300,000 and our variable costs are $45. So we're going to calculate break-even point. And the equation method is when we do it kind of longhand. We take our sales, less our variable costs, less our fixed costs, equal our profit. So we can break up our sales into the price per unit times the quantity. And that's what we're trying to solve. We're trying to solve how many units we need to sell so our profit equals zero. Our variable cost per unit times the quantity minus our fixed costs in total. So we can calculate and let profit equal zero, and we can substitute in our numbers into this equation. So from the previous slide, all we've done is we've added fixed costs to both sides. So the effect of that is the fixed costs now are on the right-hand side of the equation. So now we are substituting in the numbers that we know. So we know the sales price is $60, we know our variable cost per unit is $45, and we know our fixed costs are $300. So we can solve this. 60 less 45 is 15Q, and then we just divide our fixed costs by the 15. So the break-even point is 20,000 toys. We have to sell 20,000 toys before we start making a profit. That's important information for managers. If they have information about the market and they don't think that their toys are going to sell that many, then it's not even worth their while producing them. We all good? Okay. So that was the long way of doing it. But if you understand what contribution margin is, you can do it much more quickly. So unit contribution margin is the amount of sales revenue you have that remains after all your variable costs have been paid to cover your fixed costs and profit. So unit contribution margin is equal to the unit sales price less the unit variable cost. That's a definition. Contribution margin is sales price less variable cost per unit. So we know that our unit contribution margin in our example is $15. So that $15 means that we have $15 to cover our fixed costs and make any profit after we've covered our variable costs. So to work out our break-even point in units using the contribution margin method, all we do is we divide our total fixed costs by unit contribution margin, which is the last line that we got to using the equation method. So it's just shorthand. Okay, so if you remember this equation, you can work out your break-even point fairly quickly. In units. You can also use contribution margin as a ratio. So a contribution margin ratio is your contribution margin, so your sales price, unit sales price, that's your unit variable cost, divided by your unit sales price. So we know that the contribution margin ratio is 25% or 0.25, and that just means that 25 cents in every dollar of sales is available to cover your fixed costs and become profit once you pass break-even point. Is that all good? So you can use this contribution margin ratio to very quickly work out your break-even point in sales. So your break-even point in sales, see this is units, this is dollars. You can calculate that by taking your total fixed cost and dividing by your contribution margin ratio. So we know we have to sell $1.2 million worth of toys to break even. You could have got to that same figure by taking the 20,000 toys and timesing that by the $60 in sales price. It's just a longer way of getting to the same result. Be very careful in multi-choice questions whether they're asking you for the break-even point in units or the revenues. Okay? And it doesn't matter how you calculate it, whether you use the equation method or the contribution margin method, as long as you get to the right outcome. Okay, so this slide just tells you that the contribution margin ratio can either be calculated by dividing the unit price, by using the unit price and the unit costs, or by using total sales and total variable costs. Don't mix them together. And we also know that if the contribution margin ratio is 0.25, then the variable cost ratio must be 0.75. So if we were to divide our our variable cost ratio, so that's just the proportion of our sales price that is made up, that covers the variable costs. And you can also come to that by taking 1 minus the contribution margin. So they're all just iterations of the same relationship. We all good? So I expect that you need to know what contribution margin is because it's widely used in management accounting. You can present your profit and loss statement or your income statement as a contribution margin format. So you're actually describing or presenting your costs as fixed or variable. And you do that when you want to demonstrate the effect on profit and changes in those variable and fixed costs. Okay, the other method that you can use, you can graph it. You're not expected to do that, but basically you just graph your total costs, you graph your total revenues, and you identify the point of intersection, which is the break-even point, and you can use the area between those lines above and below break-even point to calculate your profit or loss. So your break-even point, as I said, is just where those two lines intersect. This area here represents profit above break-even point. This area here represents loss below break-even point. So you should be able to interpret these graphs, often used in management meetings. All good? Okay, so if we use an example, very simple example, we want you to calculate the break-even sales in units, giving you this information about selling coffee. 1 cup of coffee, the selling price is $1.49, the variable cost is 36 cents. The expense per month, the fixed expense is $1,300, and we expect on average to sell 2,100 cups. So I'll give you a little bit of time to calculate your break-even point in units. And you always round up because we don't talk about selling half a cup of coffee. Okay, does anyone have an answer? Yep, number 4? Great. So, how'd you get that? Yep. Yes, so the unit contribution margin, $1.49 less 36 cents is $1.13. Yep. Yep, great. So you divide this 1,300 by your unit contribution margin of $1.13 and you get this answer. You round up. All good? Any questions about that? You can do it the long way too, which is absolutely fine, particularly in multi-choice. I don't know how you've done it. All I know is whether you got the right answer. Okay. Okay, now we just want to know, with the same information, what's your break-even sales in dollars? So this is quite a simple thing to do. We knew it was 1,151 units that we had to sell. How do we get the break-even sales in dollars? We can either use the contribution margin ratio or there's a simpler method. What do we do? Fantastic. So you just multiply the break-even point in units by the selling price. We know the selling price is $1.49. So we're going to get to 1,715 or thereabouts. Is that all good? Yep, great. Okay, so we can extend on this basic model. So we might want to know, for example, how many units that we have to sell to make a certain amount of profit. Okay, so say for an example where the before tax profit we want to make is $30,000. Using the example of the toys, all we do is instead of having 0 on the right-hand side of the equation, we would have 30,000 and we would solve the equation for that. So this is your sales price by quantity, your variable cost by quantity less your fixed costs gives you this much before tax profit. So we know that the quantity that we have to sell to get 30,000 in before tax profit is 22,000 units. Is that all good? If we're using the contribution margin method, all we do is take the fixed costs, add on the profit before tax and divide by the contribution margin. Okay, so for that coffee example, now we want to make a profit of $2,500 per month before tax. How many coffees do we need to sell? Okay, so has anyone got an answer? Sorry? 1? Okay, so how did you get to that? So you take the 2,500, add it onto the fixed cost, and divide it by your $1.13, which is your unit contribution margin. Fantastic. Or you could do it the long way, using the equation. Okay. So I hope you're all familiar with how to gross up. So in some questions, they will ask you how to get to a targeted after-tax profit. And if they provide you with the tax rate, you just gross up to before tax and then use exactly the same equation. So to gross up, you would divide your after-tax profit by 1 minus the tax rate. Is everyone familiar with that? So if the tax rate is 30%, you would divide your after-tax profit by 0.7. And that would give you your before-tax profit. All good? Okay. So here it just explains that profit before tax equals profit after tax divided by 1 minus the tax rate. And this is the contribution margin method of getting to your sales volume to earn that target profit. So be careful when you read questions. What are they asking you? Is it before tax, after tax? Do they give you a tax rate? If they're talking about the number of units you have to produce to reach that targeted profit. Okay, so you might also be asked about kind of conceptual questions. What's the effect of a sales price increase? What will that do to your break-even point? So knowing that equation, the cost, volume, profit, how to calculate break-even point, you should be able to, in your head, understand the effect of different changes in the inputs. So if we have a sales price increase, everything else remains constant, that means our contribution margin per unit will increase, which means the denominator of our break-even point equation will get bigger, so our break-even point will be lower, which makes sense. If we have more profit, we'll have more contribution margin per unit, we'll have to sell less to break even if our fixed costs remain constant. If our variable cost per unit goes up, that means our contribution margin goes down, which means we'll have to sell more before we break even. Just thinking about it in terms of the equation. Okay, so we use this kind of cost volume profit analysis for pricing decisions, cost planning. Will we take on more fixed costs? What will the effect of that be on our break-even point? So if everything else remains the same and we take on more fixed costs, our break-even point will be higher. Why is that? Exactly. You have to sell more to make more contribution margin to cover those higher initial costs. And we also don't just do one analysis. We do many analyses and change the inputs, change the assumptions that we make so that we understand the effects. And remember when we talked about decision making last week, if we have a manager who's trying to make a decision, they have to choose amongst alternatives. So you want to demonstrate to them the effects of different alternatives. So what if I take on more casual labour rather than salaried labour? I'm going to have more variable costs, less fixed costs. What's the effect of that? Okay. We also want you to be able to calculate the break-even point if you have more than one type of product. So if you have, in this instance, 3 products, A, B and C, and you make them in a constant ratio of 1 unit of A to 5 units of B to 4 units of C. And that's an assumption. You have to make an assumption that this ratio will remain constant. So these products earn contribution margin per unit. So A earns $6 per unit, B earns $4 and C earns $2 respectively. And the fixed costs of the company are $510,000. So this question's asking us how many units of A, B and C do we need to sell to break even? So what we do is we calculate a contribution margin per batch. So that's fairly simple. You just take that ratio, and in this case it's at its lowest common denominator, and then you apply it to the contribution margins per unit. So for A, it's 1 by 6, for B, it's 5 by 4, and for C, it's 4 by 2, and then we add these together to get the contribution margin per batch. So we use that contribution margin per batch, and we divide our fixed costs by the contribution margin per batch, and we know that we have to produce and sell 15,000 batches to break even. But that doesn't answer our question. Our question is, how many units of A, B, and C do we have to produce and sell to break even? So we can use this information along with, we know how many units of each product are in each batch, so we can just times the number of batches by the units of product in the batch. So we know that we need to produce and sell 15,000 units of A, 75,000 units of B, and 60,000 units of C to break even. But this is assuming that that sales mix stays constant. So you need to be able to extend on your basic kind of cost volume profit analysis and do a break-even point calculation for a batch. All good? Multiple products. Okay. So the final kind of tool that we're going to teach you about today for your toolbox as a management accountant or an advisor to business is this concept of operating leverage. And I know that leverage has different meanings in finance. We talk about operating leverage in management accounting, this ratio, which is the ratio between the contribution margin and the operating profit, gives us a degree of operating leverage. So, what's the difference between contribution margin and operating profit? It's before tax in this instance, yeah. But what's the only variable that's different between contribution margin and operating profit? Fixed costs. So operating leverage is the effect, it represents the effect of fixed costs on our profit. Okay? So it's quite a useful ratio to understand and apply. So if we have high fixed costs, we have high operating leverage. Why is that? Because operating profit is our sales less our variable costs less our fixed costs, whereas our contribution margin is our sales less our variable costs. So if you have high fixed costs, the difference between operating profit and contribution margin is going to be much greater. We all good with that? Okay, but why do I care? Why do I want to calculate operating leverage? Well, it's useful. Same with cost volume profit analysis and cost estimation techniques for back of the envelope type estimations, but you need to understand this concept because you're going to be advising businesses about whether to take on higher fixed costs as opposed to greater variable costs, and so it's very useful to understand the effect of this on your profit. Okay, so putting some numbers to it, which is often really helpful to understand better these concepts. So very simply, we've got a bike example. So on the left-hand side, we've got a very simple contribution margin format profit statement or income statement. So we've got the revenue, so we know that we sold 500 bikes for $500 per bike. The total revenue is $250,000. Our variable costs are $300 per bike. We sold 500, so our total variable cost is $150,000. If we take that away from our revenues, our contribution margin is $100,000. So we know that it's $200 per bike. So if we take away our fixed costs, our profit are $20,000, is $20,000. Okay, so we can calculate the degree of operating leverage by dividing our contribution margin of $100,000 by our profit of $20,000. Remember I said the only difference is this fixed cost between the numerator and the denominator. So that gives us 5. So we have an operating leverage of 5. So what do we use that for? So it's really useful because if we know the percentage change in sales, we can use operating leverage to calculate the change in profit. So here, in this example, we're saying the company increases its sales by 10%. We've already calculated the operating leverage, so we know that the percentage increase in profits will be 50%. So that's quite a useful thing to be able to tell a manager. So we can prove that by calculating the effect on profit of this this 10% increase in sales. So if we increase sales by 10%, it becomes 275. Our variable costs also increase by 10% because that's the nature of variable costs. So because we sold more, so we take our variable costs away from our revenues, and that gives us our contribution margin, less our fixed costs, and our profit is now 30,000. So we can see that there's been a 50% increase in profit as a result of the 10% increase in sales, fixed costs remaining constant. All good? Okay. So operating leverage is your contribution margin divided by your before-tax operating profit. So the difference between your numerator and your denominator is your fixed costs, and we can use operating leverage to calculate the effect of a change in sales on profit. So I want you to calculate the operating leverage for this example. Okay, has anyone got an answer? Number one? Great. So how did you get to number one? What did you do? You worked out your contribution margin? Yep. So in total, contribution margin in total, so you took the 2,100 times the $1.49 less the 36 cents. And on the bottom, you just did exactly the same thing, but you took away the fixed costs of 1,300. All good? And you ended up with an operating leverage of 2.21. Is everyone good with that? Okay, so a lot of it is about understanding what operating leverage is so that you can then calculate it. So what we find out now is that the we want to know what the operating profit is if sales increase by 20%. Does anyone have an answer? The first one? Great. Okay, so what do we do to do this without going through the whole process of, yep? Yes, and how did you get 1.442?
First, you have to use 2.21 multiplied 2. About 20%.
Yep, so we know that there's a 44.2% increase in profit. So we know this is our profit. And you're saying we just multiply that by 1.442. Great. Does everyone understand? So that's why understanding and being able to calculate your operating leverage is really helpful to quickly understand the effect of a change in your sales. So up or down, okay? So today you've learned about cost volume or cost estimation, cost volume profit analysis for individual and multiple products and operating leverage. This will all be covered on your online quiz in week 6. So thank you for coming to your lecture and I'll see you next week.